Are you ready to take your investment game to the next level? Introducing Digital Investor, your ultimate guide to mastering the digital marketplace. Whether you're a seasoned pro or just starting out, Digital Investor brings you cutting-edge game theoretical strategies, expert insights, and real-time tips and tactics to analyze, evaluate, invest, and grow your wealth. Don't miss out on the digital revolution. Visit www.nickblacknex.com and start your journey with Digital Investor today.
No, don't grab that. No. All right. Nope. No. Kitty's on one. She started grabbing the microphone a second ago. Now she's on the wall clock. Nope. No. Come here. Oh, she's doing her tail in this little thing where means she's angry about something. Too much chicken, maybe? Hard to say. Hard to pin it down. Anyway, okay. Today we're going to talk about, well, at some point we're going to talk about the interest rate fallacy. We can throw markets up in the background for now. What's going on in the markets? Mew mew. No. I gotta get her. Hold on. No, Bubba. Down. Good girl. She just takes a little coaxing. All right. We'll go questions first. Let's see. Oh, Prime Don Fry versus Prime John Jones. Probably John Jones. Because Jones could fight big. He could get bigger. Jones' problem was just drugs, man. He just drugs. And living in the shadow of his brothers, probably. But yeah, he's kind of a psychological basket case, but he was just very weird. He was a weird fighter, too. He's a very weird fighter. He was the sloppiest, best fighter ever, if that makes sense. At his prime, Anderson Silva, I think, was the most dangerous of all those guys. I think Anderson Silva at his best was better than anyone else at their best. No one could get close to that guy. But then he started breaking his ankle and his leg and everything else. And downhill you go. Once you have a big injury like that, you're finished. Because you can't come back psychologically. You're screwed. You're like, it's always in your head. So, yeah. Yeah. Good morning, everyone. Okay. First of all, any questions you guys have, just write the word question and we'll tackle it. We had a good day. Let's see. Sunday was good. Weekend wasn't bad. Yesterday was good. This morning was okay. And then I think some people are a little uncomfortable about this looming. Oh, scrapes? I can't tell what that is. I don't know what's going on with these glasses unless they just have them programmed to make you want to buy new ones every few months or whatever. this looming government shutdown, which I think everybody has already factored that there will be a shutdown tonight, because there's no way the Democrats can just say we're not going to make a deal and then blame it on the Republicans. So that's how this works. So and they both blame each other back and forth. But I mean, this is one where it looks like the Democrats are being holdouts. So it is what it is. So the likelihood of this being this shutdown happening, I think most people have priced it in. I don't think people have priced in if they were to find an agreement, but they're too far from it. So then the issue is, okay, how long does it go? More than 2 weeks would be a thing, right? They'd start talking about it. A week to 10 days is, I think, pretty much expected. Oh, you want to know something cool? I set that fight up. I was the first one that set it up. So through my buddy Shannon, so he had been fighting in Pride, and we knew all the Pride guys. Matter of fact, I reffed one of you remember Fujita, Kazuyoshi Fujita, who was he was one of the training partners of oh gosh, he trained with a bunch of people. But anyway, Kazuyoshi Fujita. Fujita was the big giant guy. Anyway, I knew Fujita. Well, we knew Fujita and a couple of those dudes. And I'm trying to think who the I don't know if it's Kawasaki or who. There was I'm trying to think who the guy that was the handler for Pride. But anyway, in Dallas, I saw Don. Well, Don Fry was a buddy of ours, of me and Shannon's, and Shannon's. They're all still very close. And then, matter of fact, Don Fry fell asleep at my house one time. That was weird. But anyway, I saw in Dallas. I saw Ken Shamrock, and I said, "Hey." I was kind of joking. I was like, "Hey, Don wants to fight you." And he's like, "Well, it'd have to be good money." And I don't remember the exact exchange. It was in a parking lot, because I used to go train with the Lions Den guys every now and then. And then he said, I'm paraphrasing, obviously, because I don't remember exactly what was said, but he basically said, if you can get us 300,000 or 400,000 a fight, I don't know what the number was. But they ended up getting, I think Don got a 2-fight deal for $700K, and I'm sure that Ken got a good deal also. I don't know what the deal was, but I remember then I called Don. Don said yes. I got Don on the phone. I think that's what it was. I think Shannon was there with me, and we got Don on the phone. And he's like, yes. And then they made that fight happen. And then after that, Fujita, I reffed a fight with Fujita under a fake name, because he didn't want it to go on his pro record. He just wanted to get some fights under his belt. And then he came out as Kazuyoshi Fujita. And yeah. And Shannon fought Sakuraba, as a matter of fact. And Sakuraba and Fujita were close. That's how we all kind of everybody got to know everybody. But Fujita was underneath Don Fry. Like Don Fry kind of managed him. If that makes sense? Not managed him, but like he was. It's like a little blurry spot. What's going on? I get it. Yeah, it was like a little weird spot. Anyway, yeah. So that was there's the background there. So we actually made that fight happen from a parking lot. Let's see. Have you read about the Clarity Act stripping crypto rewards? No, it's not directly. What it is, and this goes back to banking quite a while ago, when I'm trying to think of what the dates were. Oh, I can't remember. So many dates floating in my head. But long story short, when bank deposit. So remember when they used to give you at a bank, they would give you gifts if you opened up a bank account. because they were limited on what a checking account can pay you. They had limited all this way back when, and then what happened is the end around was banks basically couldn't pay you a high return like savings accounts and stuff like that, because the idea was if they paid you a high return in the savings account, people would pull their money out of the bank and put it in the they would put it in savings accounts rather than checking accounts, and the banks can't lend as much on it. It would, it's all this competition, blah, blah, blah. So the banks, everybody fought. No, you can't make money off deposits. That was the whole thing. You can't make money off deposits. We can as a bank, but you can't, because we don't want people to be doing things that aren't just giving the banks money to lend out, right? Because your deposit is someone else's loan, right? So the workaround was money market accounts. Money market accounts were the end around this kind of stuff. This is what's going on with the Clarity. Well, this is what's going on with the Clarity Act, in that they're trying to do an end around banks. Well, banks are trying to prevent all of these stable issuers from offering interest, because they say that would directly compete with the banks. But third-party facilities, which will look a lot like money market accounts, will pop up, and that will be the end around. And so it's just going to be interest being paid on stable coins one step removed. That's all. So yeah. There we go. Yeah, Vanderlei Silva. I knew Vanderlei. I knew Pele, Londy Johns. I mean, knew them a little bit. Like, had met them, hung out with them a little bit in Japan. I knew Don pretty well. I knew my buddy fought Ken Shamrock, but I never even met Ken Shamrock. But it seems like he was really cool. I met Frank a few times. I used to train with Guy Metzger and a couple of their. Guy Metzger is kind of a douchebag. He was always a douchebag. I think he was mad because he was like, he missed being a star. I always think he thought he should have been a star, and he wasn't, because he just wasn't a great fighter. He's an okay fighter, but he was a dick. No one liked working with him. So anyway, yeah, I knew a lot of those guys. All right. Let's see. You got a piggy bank from your banker. Yeah, I know. Isn't that funny? Yeah, they used to. They had to give these things. It's interesting. It's interesting the big pushback there was against deposits earning interest because of capital flight. But capital is going to fly from banks because banks don't offer us anything. We can spin up our own loans now, and that's just going to get better and better, and those rates are going to get more competitive. Rich Franklin. No, I don't. I never met Rich Franklin. Wasn't he a teacher? No, I never knew. I didn't know a lot of those wrestler guys. The only guys, I mean, I knew of a lot of those guys, but I had only kind of worked with a handful of them. Like I have. Do you remember the original Ultimate? It may have been, what UFC was it, 17 or something like that, where they were still fighting like 3 times in the same night and all this kind of crap. The one that Dan Severn won. I have that belt in my theater. Dan Severn's championship belt. He gave it to us. So anyway, yeah. Oh, that's right. Yeah, I remember Matt now. I never met him. And I never met Rich Franklin. That was kind of like after I was I was training and stuff, but I wasn't just as excited about it. You know, there's just not a lot of money in it, man. You got to be... There's a lot of money for a few people, but most people, they just kind of come and go. BJ Penn, he just went to jail again for the 6th time in 3 years. Like that's BJ Penn. These dudes... They don't age gracefully. Yeah, well, we all know that doesn't mean anything. If you're a ground fighter, then of course, Hoist is a jiu-jitsu guy. He's going to be on the ground the whole fight. That's the whole point. I don't think Dan was ever really close to beating him, and Hoist was not the best fighter in the family. I mean, anyway, yeah. Henzo was better than Hoyce. High-end was okay. I know the R's you have to. Anyway, yeah. That's a mean family, man. You imagine pissing that family off at some park. Oh, that's cool. Yeah, that's cool. Yeah, I don't know the whole story with Matt Hughes. I feel like I should know it. Yeah, he was awesome. You know, his brother was a treasury agent. Matt Hughes. He has a twin or a near twin brother, who's treasury agent. Oh, train accident. Jeez, what a weird thing. Did Fry ever fight Hoyce? No. Nope. No, that was kind of after the Hoyce era. Fry was right around the Vitor Belfort era. That's another guy who would have been good if he gotten kind of the right kind of management, but I think they screwed him up. They got him too juiced up on steroids. He should have stayed around 185 instead of trying to get up to 2.25 and fight. And then when he got pummeled by Vanderlei Silva, I think that just, well, actually, no. He beat up, I think he beat Silva the first time, right? And then what was the fight that he lost that was so weird? It's when he went up in weight. He beat Vanderlei Silva. That was the surprise fight, the shocker. And then he won a few fights, and then he got clobbered when he went up in weight. I think he gassed out, and that was pretty much the end of Vitor Belfort. I think he's teaching. I think he may be here in California teaching somewhere. Anyway, these guys, they all just go. They all just disappear. Mark Coleman's a beast. I've met him a few times, but I don't know him. I mean, just met him. He wouldn't know me in a police lineup. Yeah. So those guys were all pretty cool. Pretty cool. All right. Back to the cryptos. Okay. So banking is transitioning, and they're realizing that customers are less happy. They're making less loans. And with all of these stable coins that are here and that are coming and that are going to be issued by companies and private businesses and all that kind of stuff, the worry is, if you're a banker, hey, there's going to be a mass exodus from the banking system. And I think that's a legitimate worry. I think it's a legitimate worry. And so these bankers are kind of panicking. And so they're making sure that they, through their lobbyists, through their in their pocket representatives, the Elizabeth Warrens of the world and stuff, they're trying to make sure that a stablecoin issuer can't also offer yield, because that's not fair. It would directly compete with bank deposits. And if you compete with bank deposits, you're going to lower the amount of money that banks can lend. And if you turn off, they'll frame these arguments. The gears of the economy are bank lending, which is true, except that would be the case only if there were no other alternative, and there are other alternatives. So that's, I think, what's missed in these arguments. And so the alternatives are like the Morphos of the world in the future, these lending platforms. And so when you do have those things, when you have those opportunities available to you, parking your money at Chase doesn't seem quite as interesting. Like, I've got I have more in loans through Morpho, through decentralized lending facilities than I do at Chase. Actually, I don't have any loans at Chase, but I was going to do a refi through Chase, and I thought, well, maybe I just do it against my crypto. Just refi against my crypto. Just cut that loan down by 3 or 4 points. But then I realized, I'd rather have the free cash available to invest, because that seems more powerful. Anyway, yeah. Okay. So, that's kind of the argument. That's the whole clarity thing, where they're trying to make sure that banks don't have undue competition from decentralized lending facilities and from stablecoin issuers, things like that. So the first step is they'll fight the stablecoin issuers, and then they'll go out and fight the DeFi platforms themselves. That's if I was a scumbag, douchey, borderline corrupt banker, then that's probably the way I would do it. So yeah. But again, they can just go around. They can go around those rules pretty easily just by having a second entity that works with the first entity, and it offers the return by lending or whatever means that they derive some return from. So I don't think this is that big of a deal. So yeah, we still have a lot more favorable lending environment. A lot more favorable crypto environment, regulatorily and otherwise, than we've ever had before. So again, I don't know why everything isn't just sky high. There should be everything should be in the cosmos right now. But maybe this is just some pre-government shutdown jitters. So we'll see. All right. What else? Let me make sure I didn't miss any other stuff. I think we got all of it. I think we nailed all the questions. Okay. If you guys have any more questions, ask them. Otherwise, we're going to probably spend some time talking about the interest rate fallacy. And this time I even made some slides. Let's see. So let's see if we can get it right. Oh, the interest rate fallacy. Okay, well, we don't need that banner. Okay, so let's switch gears a little bit. Let's switch gears and get to the brainiac part of our session.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Oh, good. The new season is out, right? So good. Anyway, there we go. New season. Okay, wait. Question. Are you off air on Thursdays? No, we're not off air. We just do the options only show. It's just the options session, options hour. And that way we can kind of do all the Q&A it takes in all of the crypto ETF options. Predominantly IBIT and ETH-A, which are the BlackRock, Bitcoin, and Ethereum ETFs. And so we go through and we look at all the scenarios that everybody needs, and then we get them out of there in time they can go make those trades, because Thursdays are the most liquid. That Thursday morning area is that kind of perfect golden hour for trading of options, when there's the most market maker activities. They're the most liquid. And then for rolling, or if you're buying and selling, whatever, what have you, Thursday's the day. So anyway, that's why we do options hour, specifically options hour on Thursday. There you go. Market is likely to bottom out mid-October, then hang on. I mean, it's as likely to do that as it is to go straight up, as it is to go straight down. There is no. I think it's problematic to think that anything is likely. Last week was not likely, but it happened, and it was the most money that had ever been washed out of the crypto market in history. Was it likely that one guy would sell on Sunday at 3:23 p.m. and that over the next, over the next 5 days, there would be $350 billion washed out of the market? No. That was not likely. I don't know that I would draw any likely conclusions. Yeah, place your bets is more right. Yes, everybody's gambling. I mean, macro matters. People panic, and sometimes the panic takes several days to unwind, and that's what we had. We had a panic that was set off by one person on Sunday, last 2 Sundays ago, and it reverberated through the markets for a week. And actually, if you go back, this has happened a few weeks in a row. One or two people causing huge chaos. Bitcoin people, by the way, Bitcoin whales causing huge chaos, a bunch of leverage unwinding, leverage after leverage after leverage. And pretty soon in a 10-day period, you have hundreds of billions that has unwound. Not just a billion here, a billion there, but like when it's all said and done, several hundred billion wiped off the market cap of the whole crypto space. We're back, we're below 4 trillion again. It was nice to be up at 4 trillion, but now we're back down below it. But we're still way above 3 trillion, so that's good. So yeah, and yes, the options thing is a separate thing. It's a separate animal for those people that are in the market. Because for those of you that are trading options, which is a pretty good chunk of you, it's a nice resource to have to be able to kind of sanity check what you're doing. Craig. Okay, so let's talk about the interest rate fallacy. So what do we got? Let me see. I have a slide thing. Do I have arrows? Ooh, I have arrows. This is cool. Okay. So if we're talking about the interest rate fallacy, because we are, right? If you're talking about the free money myth, the Fed's gonna print, the Federal Reserve just cut rates, and that means free money's flowing into the economy. If you listen to CNBC, Bloomberg, or any other a-hole, they will tell you, oh, they're cutting rates, free money, here it comes. Sounds exciting, but the problem is it is completely wrong. Cutting interest rates, it doesn't create money. The Fed doesn't create money. The Fed's not a money dealer. And Milton Friedman had called this out many decades ago. He called this the interest rate fallacy. You'll hear this thrown around. You'll also hear this thrown around wrong. You will hear it bastardized. And so his core point is that people often confuse cause and effect when it comes to interest rates. They mostly do. When they look at the yield curve, they're getting the exact opposite information. So when interest rates are low, and I think I have my slides with my arrows. Oh yeah, let me take off the comments just for right now. Okay, so when interest rates are low, there's this idea that that's free or easy money, right? So rates are low. People assume money's got to be easy to get because rates are low. No, in reality, low rates signal weak demand. They signal fear, economic slowdown, recession, right? Bad jobs market. What it does not signal is abundant money. And so think of it like a fever. A high temperature doesn't cause the sickness. It is a symptom of the sickness, right? So similarly, low rates are a symptom of weak conditions, weak credit demand, a fragile economy, poor access to quality cash, to cash, quality collateral or credit, right? Low rates are a symptom of the weakness, not the cause of it. So adjusting it doesn't do anything, right? So typically his core point was when rates are lower, demand is lower, loan demand is lower, bond demand is higher, which is what? A safe risk asset. So if people are flocking into the safest, most liquid instruments, it's because they don't see anywhere else to go. They're not going out and investing in riskier things. So what do you think banks are going to do? You think banks are more excited to lend into that environment? No, they are not. They are less excited. So rate cuts don't create money. The Fed doesn't create money, period, right? The Fed changing the price of borrowing to a few people. Remember, we don't get that borrowing rate. It's a few dealers that get this. So when the Fed changes the price of the borrowing rate, the interest rate, It's not the same as creating new dollars. It doesn't create new dollars. Money is created through the banking system when banks issue new loans. It's part of this whole idea that they're angry and that they're like, we don't want other companies taking our business by offering returns on savings or returns on your banking, on your dollars, because if they do that, then the people will take their money out of the bank and we can't issue new loans, right? So back to banks. Banks don't lend because rates are low. They lend when they're confident that borrowers will repay the loans. So if the lending environment is crap and you see a crappy environment and you go hide in government debt, in government instruments, banks are not stupid. They're greedy, but they're not stupid. They don't look at that and go, oh, this is a great environment to lend into. And now we make even less now that the rates are lower. No, that's actually not how banks work. If you cut interest rates in a fearful way, banks pull back on lending. They don't expand it. Low interest can freeze activity in the banking sector because banks become risk averse. They prefer to buy, the banks themselves prefer to buy safe government bonds instead of loaning to businesses or households. So when you see, this is why the yield curve is so important. It's the source of truth. The yield curve doesn't lie. Okay? So, rate cuts don't create money. So if the Fed changes the price of borrowing without changing the money stock, which they don't because they don't create money, they're not money dealers, banks lend based on confidence, on quality collateral, and capital, not low rates. So the lower rates go, the less inclined banks are to lend. Does that make sense? So lower rates push banks themselves into safe assets instead of new lending. So as policy rates go down, lending goes down, treasury buying goes up, new money creation, well, it doesn't exist. Like it's just not happening. It's not a thing. So what is the bond market behavior? When rates are low, investors pile into government bonds. Why? Because they're scared of risk in the real economy. Bond buying is essentially hiding out in safe assets. So when you see a rush into treasuries, it's not a sign that the economy is full of free money. It's a sign that people don't trust the private market with their cash, and they would rather hide in safe liquid instruments. Does that make sense? So bond market wise, you have this flight to safety. When they look at the market, these are all money dealers. They look at the world and they say, I'm not lending to businesses. I'm not lending to households. I'm just going to go hide in government debt. I'm just going to go buy some safe liquid instruments, and I'm not going to get paid as much, but I know that the chances of not being paid back by the government are zero. They will pay me back. Whether their dollars are worthless or not, they will pay me back. So investors hide in treasuries when they are fearful. Low yields reflect a high demand for those safe liquid instruments, right? And why is this? Because again, it's like a seesaw where the price of bonds is low, the yield is high. Why? Because the yield entices buying. So as more people buy, the price of those bonds go up because there's competition for those bonds. And the yield goes lower because you don't have to incentivize purchasing. So they move like this. They move inverse. So if you have a lot of treasury demand, yields go down, just like our cool arrows. Risk appetite is down. Private credit growth is down. Usually means a lot of things are down. Hiring is down. Oh, well, there could be another green arrow is up for layoffs. Layoffs usually go up. The bond market can tell you a lot about what's really happening. And so just because, math, you realize that there's a backwards logic in this kind of whole free money thing. So again, if you see people rushing into treasuries, it's a sign the economy is not full of free money. It's a sign that people do not trust participating in the economy. They want to hide in safe liquid instruments, and that's government debt, right? Safest, liquidest stuff you can get. And U.S. government debt is the safest, liquidest debt of all the crappy government debts that are out there. It's just the best one to own. Bills, notes, and bonds. So then you have the backwards free money logic, right? And again, cutting interest rates does not inject cash into people's pockets. Cutting interest rates does not guarantee growth. Cutting interest rates does not force banks to lend. Cutting interest rates is not a signal of anything good. It is a signal of weakness. Cutting rates is when the Fed, remember, the emptiest, dumbest fucking people on earth, the dumbest people on earth, when they finally figure it out with old, outdated, downward revised data, a year or more old, when they finally get it, the dumbest people on earth, then you know the signal is a signal of weakness. It's already been weak. It's been weak for a long time by the time this information dribbles down into their little tiny little brains. So remember, these are empty suits, dude. These are career banking politicians. It's the worst of the worst. And so again, cutting interest rates doesn't inject cash into society, certainly doesn't put cash in your pocket. It doesn't lower your borrowing rates because, by the way, banks ain't lending to you, bub. Like when rates go down, first of all, that's a whole other thing. We could talk about that. But treasury rates are not mortgage rates are loosely determined by treasury rates, which are loosely determined along the rest of the yield curve, and not really much determined at all by what the Fed might do at one point at the near end of the curve. It just they don't have any effect on the rest of the curve. None, right? And they don't really even have any effect right there. They're chasing the market with their rates. They're always chasing. So they look at what the bond market has already done and they just chase it. It's kind of like their little cheat sheet. Oh, what did the bond market do? Okay, they must be right. Now, publicly they'll say the bond market's about, oh, this is vigilantism. But remember, these are empty suits. These are just poorly cognitively functioning individuals. And so where the fallacy ultimately lies is that people believe that low rates equal stimulus. And in their mind, stimulus, that's money printing. Yes. And even stimulus isn't stimulus in most cases. Like quantitative easing, which is neither quantitative nor actually easing, actually doesn't pump any money into the economy. Not $1. Not $1. It's the Fed forcibly swapping illiquid bank reserves for actual quality collateral sitting on bank balance sheets, forcing the banks to let go of their treasuries, usually short-term on-the-run treasuries too, the most safe, most liquid, most quality collateral they got. They're taking their best collateral and giving them bank reserves, which they can't do anything with. And the idea is, oh, well, I'll now incentivize you to go out and lend. The banks are like, fuck you. You've given me nothing. So again, stimulus doesn't stimulate unless the transfer mechanism is from the Treasury. Now remember, the Fed doing QE, it's all fake. It's all funny money. It's a fugazi. But when the Treasury cuts checks, well, then they cut a check, right? That's money right into society. So the transfer mechanism is what determines whether something is money printing or not. Just calling it stimulus doesn't. And low rates, they're 10 steps further away than QE is. So low rates don't equal stimulus, and neither of those two equal money printing unless they print a check and fucking send it to you or money shows up in your bank account. And with rate adjustments, no. And with QE, no. So in truth, money creation requires lending. Lending requires confidence. So without that, rate cuts are like loosening the price tag on an item that no one feels safe buying anyway, right? Just no one, oh, you cut the price of that hyena. Maybe we will get that, Timmy, instead of a golden retriever. No, No, you won't. That's a bad parenting. For anybody out there, getting a hyena as a pet, no matter how much of a discount it is a bad idea. So the analogy you can kind of think of like going into a club, like a nice club, and everybody has a club around town, a fancy club, if you will. So think of interest rates like the cover charge at a club. Okay, if the club is hot and everybody wants in, even a $50 cover charge won't stop people from lining up. Like, this is the place, man. Everybody there is either I would have said Playboy model, but those are kind of haggard these days. A Maxim model. They're all Maxim models. Maxim is still good, right? I don't know. What do people in jail read these days? It's not Playboy. Probably Maxim. Maxim girls. Okay. So it's all full of Maxim girls. They're all beautiful. So you're going to pay the $50 cover. You're going to pay the $50. You're going to go get a table. You're going to have fun. But if the club is empty and it's postpartum Playboy models, you can drop the cover to $1. Ain't no one going in there. You don't want postpartum Playboy Playmate Pamela serving you drinks. You don't. So the problem is not the price. It's all about demand. This is all demand function. Friedman's interest rate fallacy is low rates don't mean that money is easy. They mean that the economy is weak, right? That's what low rates mean. Low rates, bad economy, right? Usually. Are there weird moments that this is not accurate? Moments. But for the other 99.999% of the time, low rates mean money is not easy. It means the economy is weak, right? No money is created at all simply because the Fed cut rates. Not one fucking dollar is created. So when you hear about, oh yeah, here comes the free money. No, stupid. And I used to say, ask people to explain this, but if you do, you'll actually find yourself, you'll lose IQ point. Your brain will start to melt because of the weird sloppy ass arguments people make. No money is created because of Fed rate cuts. None. Lending creates money. Banks are the real central banks. Lending depends on confidence. If you're at the table with all your relatives and everybody there just told you how they just declared bankruptcy, and Uncle Steve is like, hey, can I borrow $10,000? You're going to tell Uncle Steve no. And you're going to tell him, put your pants back on and don't come back to the table naked. Uncle Steve, freaking weirdo. Bond markets show fear, not prosperity, when yields collapse, right? So when people are when they're piling into safe liquid instruments, it's because they are scared, right? Scared doesn't equal lending into society. So next time you hear Fed rate cuts, free money, you can definitely say with confidence, no, that's not how it works. And so some of the things you need to grapple with are, okay, when you see this slow exodus towards decentralized products, a lot of this is because I think people are coming to terms with some of these concepts. And they're realizing that banking is not as clever as maybe they thought it was. Bankers are not as clever. Remember, bankers are just glorified salesmen. And so the more you learn about this system, I mostly use the kind of a metaphor of like a pocket watch. Is it a metaphor? Yeah, I guess it'd be a metaphor. I look at finance as a pocket watch, all of finance, the whole financial system. And inside that is big E and small e economics and yield curves and debt creation and what's the difference between money and currency and all, what the Fed does and doesn't do, what central banks do and don't do, what banks are supposed to do and don't do. And all these are all gears. These are all gears in the economy, in the kind of whole financial pocket watch, right? All these little things. And so if you start taking the gears out and just trying to understand each gear, at some point you get it. You just kind of get it. And so when people tell you stuff, you say, nope, that's slop. That's not true. You're oversimplifying. And when you understand enough, you don't have to be a genius, but when you understand enough, you start to be able to get your cause and effect correctly, right? You're not going to call things perfectly on timing and all that, but you at least get cause and effect. Cause, effect, not the other way around, right? It's not effect and then cause, unless it's in some system of some superposition of particles in space and some multi-universe quantum effects and all this kind of shit. But in the world we live in, it's cause first, effect second. Okay? And because of that, you can figure most of this out. And you can certainly figure it out a lot better than your local financial advisor. These guys don't know anything, man. They don't know anything. It's so bad. Like I shouldn't have to be explaining financial products to bankers that are trying to sell me financial products. Like that's how it works. I go into Merrill. I have a meeting with their wealth people, and I explain to them the products they've never heard of that I want. And then they go and research it. That's not how it's supposed to be, man. So, but you know what? I'd rather it be that way than have them mansplain me the things they're going to sell me that they also don't understand. So that's just the world that we live in. So you need to understand the pocket watch. It is really important. So kind of understanding this interest rate fallacy, that's one big part of it. It lets you kind of understand the Fed and the inefficacy of the Fed and the impossibility of the Fed ever having any causal effect on markets other than just performance theater, just blah, 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 blah. That's all they are, is a mouth organization. They don't really contribute anything meaningful. And there's probably a good argument that the Fed no longer needs to exist, like period, at all. So, but that's another argument for another day that other people will have. Lending is a con game. Well, it's not a con game. I mean, I think lending is pretty normal, right? You would lend if you think that there's a chance that the money's coming back, right? You could be a lender. I'm sure everybody here has given a loan to a friend or whatever. That never works out, by the way. But I'm sure people here have extended loans to friends and family, or in the business environment, you extended loans in the business sense. So there's a lot of money to be made lending. I mean, crypto lending, we do that too. Like there's money to be made. You expect to get it back with some interest. They are parting ways with the interest because they need the money now. And so ideally everybody's happy, and that interest rate should reflect the amount of risk that you're taking and the amount of excess that they're willing to pay for that opportunity. I saw one of Jeff Snyder's shows. This is yesterday's show, and he talked about factoring, and I didn't realize that the rates on factoring were so big. But basically, factoring is you're a company and you have a accounts receivable. Let's say you're owed, it's 90-day period. I forget what they call that, net 90 or whatever, where they buy something today and they have to pay within 90 days. And a lot of times factories and big companies and wholesalers and distributors and auto parts places, this was in the auto parts industry because a big company just declared bankruptcy. And so basically they had been involved in a lot of factoring. What led to their bankruptcy was a bunch of investors were very curious about the amount of factoring they were using to create the cash they needed to meet their nut. And they were like 6 billion underwater, something like that. And so by doing this factoring, you're basically saying, hey, I have all these clients. They owe me in 90 days. I'll sell that to you now for a discount. And then you keep the spread. So okay, like payroll, accounts receivable financing. Yeah. I think it's very similar. It's probably the same damn thing, just relabeled, right? But he was referring to it as factoring, and they did in this big letter. The investors are anyway. The company's in bankruptcy, and so these guys were charging like a 30% fee over 90 days. 30%. Holy shit. Think about how much money that is. So what are you doing? If you're on the factoring side, if you're one of these companies extending, if you're doing the buying, like if you're basically buying these accounts receivables, what are you going to do? You're going to do a lot of due diligence, aren't you? You're going to go check out these companies and be like, okay, let's see if these are quality payees. Let's see if they're actually going to pay us back in 90 days. And then as you do that, you start realizing, oh shit, these guys don't have the ability to pay. These guys are all broke. They're not going to pay you back. Hell, that's probably why you're bankrupt in the first place. So you got to be very careful. If you're the lending side of factoring, you got to be very careful. But these are basically just like really hard money loans, like really hard. God, I mean, the hardest. I think it's like an annualized 30%, but against that 3-month period. I guess maybe it's more. Gosh, yeah, that sounds like you probably did pretty good. But on the other side of it, it's probably hard to collect on medical bills. So I'm guessing that's difficult. But anyway, so I just thought that was interesting, and so that's just one more thing that you factor into your pocket watch. So okay, cool. Well, factoring is a thing. This selling. Well, the same thing as these paycheck companies, right? That'll like, I'll front you the money now and charge you on your paycheck. You just bring that paycheck in. So paycheck loans and all this kind of stuff. Which I met the dudes. Oh man, what is the guy's name? There's a couple of them, and I met the dudes. The first dudes. I actually met them at some conference, and they told me this whole idea about paycheck loans, like they started it. It was a really cool story. I don't remember the whole. I'll have to think about it for a few days, and maybe I'll recount the story for you. But they were at a bar. These dudes were at a bar, and they started scribbling, and they came up with this idea of paycheck loans, advanced paycheck loans, and they made a freaking fortune. They also expanded too quickly and got blown up a little bit, but they made a lot of money. These dudes were minted. Did I meet those guys? Maybe something to do with the car industry. But anyway, yeah, I met the dudes that created that paycheck, quick loan, all that kind of crap. I met them in Texas. Anyway. So yeah, those are just more pieces more gears in the pocket watch that are now identifiable. And what happens is you just start having a better overall framework for how the system works. And then what comes out of it is much, much less shocking, right? So it helps you emotionally because you're not shocked with the outcomes, and you look at the incentives. And they pretty much determine the outcomes in any scenario, right? Incentives determine the outcomes. You show me the incentives, I'll show you the outcomes. Charlie Munger. And all of this is about being a little bit better than your peers, a little bit more than half the time. That's all you have to do. You just have to be a little bit better than your peers, a little bit more than half the time. And you just float by. And so I think that's something that we should all endeavor to accomplish. Ouch. I have these new shoes, but they're really sharp on one edge. They're badass, but they're sharp. Like the part that wraps around your foot is sharp. I got to figure that out. Anyway, stay in school. Don't do drugs. Don't do anything my poor and solvent drunk, starting a meth grandmother or Brandon wouldn't do, which is very little. And we will see you guys tomorrow.